This is Saturday, February 28th, 2026, and in the last 72 hours, something happened in the silver market that I have been watching for years, but never thought I would see happen this fast. The COMEX just registered a drawdown of 52 million ounces in a single week. Let me say that again so it sinks in. 52 million ounces left registered COMEX vaults in 7 days. And at the same time, silver just touched $92 an ounce on the spot market, a number that most analysts told you was years away. Billions of dollars in paper contracts repriced in a matter of hours. The market is moving so fast that the spread between paper silver and physical silver cracked open in a way this market has never seen before. If you are watching this right now and you are confused, if you are scared, if you are angry that you did not see this coming, I need you to stop, take a breath, and watch this entire video. Because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. The mainstream financial media is going to tell you this is a commodity rally, that it is inflation, that it is industrial demand. And yes, those things are real, but they are not what caused what happened this week. What caused this week is something much deeper, much more structural, and much more important for you to understand right now. Here is what is happening. Silver spot hit $92.14 on Thursday, February 26th, 2026. That is a 34% move in under 6 weeks. At the same time, premiums on 1-ounce American Silver Eagles at major dealers jumped to $14.50 over spot. The Perth Mint in Australia suspended new wholesale orders for 90-day delivery. The Royal Canadian Mint quietly extended lead times on 1,000-ounce good delivery bars to 11 weeks. And the COMEX, the exchange that is supposed to be the global price discovery mechanism for silver, saw its registered inventory fall from 141 million ounces on February 1st to 89 million ounces by February 27th. Let me say that again so it sinks in. 52 million ounces of silver left the deliverable vaults of the COMEX in 27 days. The price is exploding, but you still cannot buy the product, not at the price they are showing you on your screen. Does that make sense to you? Does that sound like a real market? In a normal market, when the price rises 34%, supply floods in. Producers rush to sell. Recyclers melt old silverware. Refiners run double shifts. That is how commodities work. That is the basic law of economics that every finance professor on earth will tell you. Price goes up, supply goes up. But that is not what is happening. Supply is contracting. Delivery timelines are extending. Vaults are draining. And the price is still rising. Something is very wrong. And by the end of this video, you will understand exactly what it is. This channel exists for one reason, to give you the analysis that institutional desks do not want retail investors to have. If that is the kind of content you want, make sure you are subscribed and have the notification bell on, because what I am about to walk you through today is the kind of breakdown that could genuinely change the decisions you make in the next 90 days. A few weeks ago, I made a video on this channel. In that video, I told you that the COMEX silver registered inventory was approaching a critical threshold. I told you that lease rates were spiking in a way that historically preceded delivery stress events. I told you that the ratio between open interest and registered inventory was flashing a warning that the market was structurally vulnerable. And I told you that when this broke, it would break fast. That video was correct. But here's what I did not expect. I did not expect the Royal Canadian Mint and the Perth Mint to move simultaneously. I did not expect wholesale suspension of new orders from two of the world's 3 largest sovereign mints in the same 7-day window. I did not expect lease rates to hit 4.8% annualized in a single session, which is the highest reading since the Hunt Brothers crisis of 1980. And I did not expect the LBMA to issue a quiet internal notice on February 24th, informing member banks that good delivery silver bar availability in London was, quote, critically constrained for immediate settlement. That is what I did not expect. And that is what we need to talk about. Let me explain how the silver market works, because most people do not understand this, and that misunderstanding is costing them real money right now. The silver market is not one market. It is 2 markets operating in parallel, connected in theory, but increasingly disconnected in practice. The first market is the paper market. This is where banks, hedge funds, commodity trading advisors, and algorithmic systems buy and sell contracts that represent silver. These contracts are traded on the COMEX in New York and on the LBMA in London. On any given day, the volume of silver traded in these 2 venues represents somewhere between 200 and 400 times the amount of physical silver that actually changes hands. Let me say that again, 200 to 400 times. The paper market is like a giant poker game where players push enormous stacks of chips back and forth across the table, but the actual casino only has a fraction of what those chips represent sitting in its vault. Most players never ask for the cash. They just keep playing with chips. The system works as long as everyone agrees to keep playing with chips. The second market is the physical market. This is where refiners, industrial users, sovereign mints, jewelry manufacturers, solar panel producers, electronics companies, and individual investors buy actual silver, real metal, bars and coins that you can hold. These two markets are supposed to stay connected through a mechanism called arbitrage. If the paper price moves too far from the physical price, sophisticated traders are supposed to step in, buy physical, deliver it against paper contracts, and close the gap. That arbitrage mechanism is what keeps the two markets honest. Here's what you need to understand. That mechanism is breaking down right now. And when it breaks down completely, the paper price and the physical price become two different things entirely. Let me show you the evidence, because I am not going to ask you to take my word for any of this. I am going to show you, institution by institution, location by location, what is actually happening in this market right now. The COMEX registered silver inventory. This is the silver that is legally available to be delivered against futures contracts. As of the close of trading on February 27, 2026, registered inventory stands at 89.3 million ounces. On February 1st, it was 141.2 million ounces. That is a drawdown of 51.9 million ounces in 27 calendar days. The current open interest on COMEX silver futures represents approximately 680 million ounces of silver in theoretical commitments. Let me do that math for you. The COMEX has 89 million ounces available for delivery. There are 680 million ounces worth of contracts outstanding. That is a coverage ratio of 13%. Let that sink in. For every 100 ounces that paper says exists and is deliverable, only 13 ounces actually sit in the vault. Pay very close attention to that number because it matters enormously for what comes next. The Perth Mint in Australia, one of the largest and most respected sovereign mints in the world. A government-backed institution that has been operating since 1899. On February 22, 2026, the Perth Mint sent written communication to its wholesale distribution network stating that new orders for silver products requiring 90-day or shorter delivery would be suspended pending a review of raw material availability. This is not a small dealer running short on inventory. This is a sovereign mint backed by the government of Western Australia, telling the world's largest silver wholesalers that it cannot promise to deliver product within 3 months. Let that sink in. The Royal Canadian Mint in Ottawa, also government-backed, also one of the world's premier silver producers. On February 20th, 2026, the Royal Canadian Mint updated its wholesale delivery schedule to show an 11-week lead time on 1,000-ounce good delivery silver bars. 11 weeks. For context, 6 months ago that lead time was 2 to 3 weeks. The lead time has grown by roughly 400% in 6 months. Let that sink in. The LBMA in London. This is the most important silver trading hub in the world outside of New York. On February 24, 2026, the LBMA circulated an internal notice to member banks. The notice, which was obtained and reported by Reuters Precious Metals Desk on February 25th, described good delivery silver bar availability for immediate settlement as, and I am quoting directly here, critically constrained. That is a two-word phrase from one of the most conservative, institutional, understated financial bodies on the planet. Critically constrained. These are not people who use words like that lightly. Let that sink in. The Shanghai Futures Exchange in China. Chinese silver futures open interest has risen 67% since December 1st, 2025. At the same time, withdrawals from SHFE silver vaults have accelerated to their highest pace since the exchange began reporting this data in 2014. Chinese industrial users, particularly in the photovoltaic solar panel manufacturing sector, are pulling silver out of exchange vaults and moving it directly into production pipelines. China installed 320 gigawatts of new solar capacity in 2025. Each gigawatt of solar capacity requires approximately 15 to 18 metric tons of silver. You do not need to be a mathematician to see that those two numbers together create a structural demand problem that does not go away when the price goes up. Let that sink in. The Sprott Physical Silver Trust in Toronto. One of the most straightforward vehicles for tracking genuine physical silver demand from institutional and retail investors. In the 7-day period ending February 26, 2026, Sprott added 8.2 million ounces of silver to its trust. To put that in perspective, Global silver mine production runs at approximately 27,000 metric tons per year, which is roughly 870 million ounces annually, or about 16.7 million ounces per week. One trust, in 1 week, absorbed nearly half of global weekly mine production. Let that sink in. The iShares Silver Trust, ticker SLV, in New York, the world's largest silver ETF. Despite the price rally, SLV has seen net outflows of 14.3 million ounces since February 1st. Now, at first glance, that sounds bearish, but here is where it gets very interesting. Those redemptions in a physical-backed ETF do not disappear. The silver has to go somewhere, and we know from custodian reports that a significant portion of those redemptions are being taken as physical delivery rather than cash settlement. Sophisticated investors are not selling silver. They are extracting it from paper structures and converting it to physical bars. Pay very close attention to that distinction. But it gets worse, and this is perhaps the most important data point I am going to show you today: silver lease rates. If you do not know what lease rates are, here is what you need to understand. When a bank or a financial institution needs to borrow physical silver to settle a delivery obligation or to support a short position, they pay a lease rate to the owner of that silver. When silver is abundant and easy to borrow, lease rates are very low. Sometimes they are even negative, meaning lenders will pay you to take silver off their hands. When silver is scarce and in high demand, lease rates spike. On February 26, 2026, 1-month silver lease rates hit 4.8% annualized. That is the highest reading in 46 years. The last time lease rates were anywhere near this level was January 1980, when the Hunt brothers had cornered so much physical silver that the entire lending market seized up. I want you to think about that. The metric that measures how difficult and expensive it is to borrow physical silver is flashing the same signal today that it flashed at the peak of the most famous silver squeeze in history. That is not coincidence. That is a data point. Now let me tell you who is doing what in this market, because this is perhaps the most important part of this entire video. There is a very clear and very consistent geographic pattern that has been developing since late 2024, and it accelerated dramatically in the first 2 months of 2026. American financial institutions, the large commercial banks that dominate COMEX silver trading, have been systematically net short silver futures for the better part of the last 3 years. The 4 largest commercial banks reportable in the CFTC's Commitments of Traders report held a combined net short position of approximately 312 million ounces of silver as of February 18, 2026. That is their exposure. They are short. They need the price to go down to make money on those positions. They have every incentive to suppress the paper price of silver because their book is positioned to profit from silver being cheaper. Meanwhile, Asian central banks, Chinese state-owned enterprises, Indian jewelry and industrial buyers, and Middle Eastern sovereign wealth funds have been systematically and aggressively accumulating physical silver. The People's Bank of China added silver to its reserve asset disclosures in November 2025 for the first time in its reporting history. India imported 5,800 metric tons of silver in calendar year 2025, a record that surpassed the previous all-time high by 31%. The Abu Dhabi Investment Authority disclosed a new precious metals physical holding program in January 2026 that includes silver as a core component. American institutions are short paper silver. Asian and Middle Eastern institutions are long physical silver. One side is playing a video game. The other side is taking home the prize. This is not new. This has been the pattern for as long as I can remember, but the scale of it right now is unlike anything I have seen in the data. Let me show you the technical indicators that confirm everything I have just told you, because if the narrative alone is not enough for you, the numbers will be. The gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio is high, silver is undervalued relative to gold. When it is low, silver is overvalued relative to gold. The long-run historical average for this ratio is approximately 55 to 1. In February 2025, this ratio peaked at 104 to 1, meaning silver was historically cheap relative to gold. As of the close on February 27, 2026, with silver at $92 and gold at approximately $3,180 per ounce, the ratio has compressed to 34.6 to 1. In roughly 12 months, the ratio moved from 104 to 34. That is a compression of 70 points. The last time the gold to silver ratio moved that far that fast was the year 1980. There is that year again. The silver basis. This is a more obscure technical indicator, but it is extremely important right now. The basis measures the difference between the nearby futures price and the spot price. In a normal, healthy market, the futures price should be slightly higher than the spot price to account for storage costs and financing. When the basis goes negative, meaning spot is higher than futures, it is called backwardation. Backwardation in a commodity market is a screaming signal that physical supply is extremely tight and that people are willing to pay more for silver today than for silver delivered in the future. As of February 26, 2026, silver entered backwardation across the first 3 contract months on COMEX. That is a panic signal. Sophisticated traders call this a delivery squeeze. And when a commodity with 680 million ounces of outstanding paper commitments and only 89 million ounces of deliverable supply enters backwardation, the math of what happens next is not complicated. Let me connect all of this together for you, because I want you to leave this video with absolute clarity about what you have just witnessed. What we are witnessing is the convergence of 3 separate crises that have been building for years and are now expressing themselves simultaneously. The first crisis is a supply crisis. Mine production has not grown meaningfully since 2016. The world produces roughly the same amount of silver today as it did a decade ago, despite the fact that demand from solar panels alone has grown by 250% in that same period. The pipeline is empty. The second crisis is a structural crisis in the paper market. The COMEX has been the mechanism through which large financial institutions have suppressed the price of silver by issuing paper contracts far in excess of the physical silver that underlies them. That system functions only so long as the vast majority of contract holders never demand physical delivery. When enough players start demanding delivery, the system breaks. We are watching it break right now in real time. The third crisis is a geopolitical crisis. The movement of physical silver from Western paper markets to Eastern physical vaults is not random. It is a coordinated, strategic repositioning by sovereign entities who understand that the current financial system is undergoing a fundamental restructuring. I believe we are approaching the breaking point where the paper price and the physical price formally separate into 2 different numbers reported in 2 different markets. Now let me tell you what this means for you, and I am going to be very direct here. No sugarcoating. If you are holding silver futures or silver ETFs like SLV, you are holding a paper claim on silver. That paper claim is only as good as the institution backing it. In a normal market environment, that is fine. In a delivery crisis that we may be entering, the question you need to ask yourself is whether you want exposure to the price of silver or whether you want actual silver. Those are 2 different things. They have historically been interchangeable. They may not be interchangeable for much longer. If you are holding physical silver already, either in your possession or in allocated storage at a reputable vault, you are in the strongest possible position. The asset you hold is the asset everyone is scrambling for. Your job right now is not to act impulsively on a 34% rally. Your job is to hold, to understand what you hold, and to not let short-term price volatility make you do something your future self will regret. If you are looking to buy and you have not yet established a position in physical silver, the message I want to give you is not one of panic buying. I want you to approach this with discipline. Premiums are elevated. Availability is constrained. If you chase the spot price at $92 and pay a $14 premium over spot, you are entering at $106 effective cost. That may still prove to be the right decision over a 3 to 5 year horizon, but you need to go in with eyes open, with a position size that does not create financial stress in your life, and with the understanding that this market will be volatile in both directions before the structural resolution plays out. Some people will say this is conspiracy theory. They will say the silver market is functioning normally, that futures markets are just tools for hedging, that institutions short silver to hedge their physical inventory, that lease rates spike all the time. To those people, I say, look at the evidence. 52 million ounces left COMEX vaults in 27 days. 2 sovereign government mints suspended or severely restricted wholesale orders in the same week. The LBMA described immediate silver availability as critically constrained. Silver lease rates hit a 46-year high. Gold to silver ratio compression matched the fastest move since 1980. Silver entered backwardation across 3 contract months simultaneously. The Sprott Physical Silver Trust absorbed nearly half of 1 week of global mine production in 7 days. Physical silver premiums on American Silver Eagles reached $14.50 over spot at major national dealers. Indian silver imports broke the all-time annual record by 31% in 2025. The People's Bank of China added silver to its reserve asset disclosures for the first time in its history. That is not conspiracy, that is data, that is facts, that is reality. Let me show you the bigger picture, because what is happening today did not start today. The silver market has been running a structural deficit, meaning the world consumes more silver each year than it produces from mines and recycling for the better part of the last decade. The Silver Institute, which is the industry's own trade body, published data showing that the global silver market ran a physical deficit of 265 million ounces in 2024. That was the third consecutive year of record deficits. To put that in context, 265 million ounces represents roughly 30% of annual global mine production. The world used 30% more silver in 2024 than it dug out of the ground. Where did that 265 million ounces come from? It came from above-ground stockpiles. It came from ETF redemptions. It came from governments drawing down strategic reserves. It came from investors who sold at lower prices. Think of it like a bathtub. The faucet is on, representing mine supply. But the drain is open, representing industrial consumption. And for 3 years in a row, the drain has been flowing faster than the faucet can refill. The bathtub is getting emptier. And the COMEX registered inventory number, which just hit 89 million ounces after draining 52 million ounces in 27 days, is showing you exactly how empty that bathtub is getting. This is not a short-term issue caused by 1 week of unusual trading. This is a structural problem that has been building for years and is now expressing itself in prices, in delivery timelines, and in lease rates simultaneously. Now let me tell you what I believe happens next. I believe the 90-day window we are entering, March through May of 2026, is the most consequential period for the silver market since 1980. Here's why. The May 2026 COMEX silver futures contract is the next major delivery month. Open interest in that contract as of February 27th represents approximately 180 million ounces of silver in theoretical delivery commitments. The COMEX has 89 million ounces of registered silver available. If even 20% of May open interest stands for delivery, that is 36 million ounces that needs to be physically delivered. From a vault that currently holds 89 million ounces and is draining at a rate of nearly 2 million ounces per day. The math is not complicated. I'm not saying the Hunt Brothers scenario of 1980 will repeat exactly. Markets have changed. The COMEX has changed. Regulators have tools they did not have in 1980. But the fundamental dynamic is the same. More paper claims than physical supply. A price that is rising. Lease rates that are spiking. Vaults that are draining. These conditions have historically resolved in only one direction. The paper market either forces a cash settlement rather than a physical delivery, which confirms everything I have told you about the disconnect between paper and physical, or it forces a price adjustment violent enough to stop the delivery demand. The question is not if this resolves. The question is not whether the math catches up with the market. The question is when. And based on everything I have shown you today, I believe the answer to that question is measured in weeks, not months. Now, there are 3 types of people watching this video right now. The first type is scared. They own silver, or they are thinking about silver, and the volatility of a 34% rally in 6 weeks is making them nervous. They are wondering if they missed it. They are wondering if they should sell. They are looking at $92 and thinking this cannot possibly keep going. The second type is confused. They vaguely knew silver existed as an investment. They have been hearing noise about this rally. They landed on this video trying to understand what is actually happening. They are not sure whether to believe the data or dismiss it as fringe financial content. The third type already understands. They bought physical silver months or years ago. They watched the COMEX inventory data. They tracked the lease rates. They saw this coming. And they are watching this video to confirm that what they are seeing in the data is real and not a hallucination. Which type are you? The paper price of silver rose 34% in 6 weeks. During that same 6-week period, 2 sovereign government mints suspended wholesale orders. The LBMA declared immediate silver availability critically constrained. COMEX registered vaults lost 52 million ounces. Silver lease rates hit their highest level in 46 years. Silver entered backwardation across 3 contract months. Premiums on retail silver products rose to $14.50 over spot. Physical demand from Sprott's Trust alone absorbed nearly half a week of global mine production in 7 days. India broke its all-time silver import record. China's central bank disclosed silver reserves for the first time in its history. One of these things is a lie. The $92 spot price printed on your trading screen, or the physical market that cannot source the metal to deliver at that price. And it is not the physical market that is lying to you. This is what a delivery crisis looks like in its early stages. This is what happens when a paper market that is operated on the assumption that most contracts will never demand physical delivery suddenly confronts a world where everyone wants the physical metal. This is what manipulation looks like when it starts to fail. The price ran up because the manipulation could no longer hold it down. The vault drain tells you the physical is leaving. The lease rates tell you borrowing the metal is nearly impossible. The mint suspensions tell you supply chains are breaking. And you get to decide which side of this you want to be on. The side that holds a paper claim on metal that may or may not be there when you go looking for it, or the side that holds the metal itself. That is not a market. That is a magic trick. And now you know how the trick works.